Welcome back to FT Markets. I'm joined by Andreas Utermann of Allianz Global Investors and Diana Choyleva of Lombard Street Research to talk about how markets will pan out over the next few months. Last time you were here, Andreas, you suggested it was a good idea to be cautious on equities and to hold some cash ready for opportunities to buy on dips. Do you think that played out quite well?
I think it played out all right. The view that we took at the time was that markets had got a little bit ahead of themselves. Earnings and growth hadn't caught up with valuations, and therefore we felt that we were heading into a more volatile period, which is exactly what happened. I think the pullback that we saw was one of those dips that I would expect, and I would expect actually going forward similar market behavior. So having a bit more cash, particularly given that the opportunity cost of holding cash is virtually zero, is a good idea to be able to benefit from this sort of market volatility which we've seen and which we will continue to see.
Diana, you were more bullish on equities, and obviously we did see significant volatility in October. So was that unexpected for you?
It wasn't necessarily unexpected. I watched the video last night to remind myself of what we were saying, and I thought, looking at that 6 minutes excerpt, that Andreas' comments at that time were very prescient, and what he said about holding cash and taking advantage of volatility and buying on the dips. We got it wrong from the point of view of being bullish of equities, DM equities versus DM bonds. In fairness, at that time I was talking a lot more about the US economy and how investors should position themselves for the coming increase in interest rate. And in that sense, that was marginally okay for the that call was marginally okay for the US economy per se. But where we were surprised was with the outcome in the euro area.
Looking ahead, we've just had the end of QE and we've just had the eurozone bank stress tests as well. Do you think now markets are looking ahead to interest rate rises? Are they mourning the end of QE, or are they celebrating the end of QE? And what can we expect in terms of, will we see rising bond yields, rising equities? How's it likely to pan out, Andreas?
I think it's way too early to tell, to be frank. I think we've seen this particular movie before, not only in this recent financial crisis, but also in Japan. And I think the outcome's not written yet. The market's really caught between concerns around potentially a global deflationary environment and the hope that rates ultimately might rise. If we're in the latter environment, and that pans out over the next 6 to 9 months, I think this current volatility, which is induced by the concern, fear around tightening, might be very short-lived because the markets have already got through that twice over the past 12 months.
How do you interpret that for asset classes?
Well, I think long-term it's bullish for equities. Short-term it's probably quite concerning for fixed income instruments.
Okay, and Diana?
I would say we're back in the same story again, where the US economy outperforms the rest of the world, which is very bullish for the US dollar. And in an environment, again, in a part of the cycle where you have the potential increase in interest rates, but still the economy operating below trend, so weakening inflation, US equities should outperform US bonds. But that's in isolation. If we then look at the rest of the world, we find ourselves with the euro area, China and Japan potentially being areas where significant risks to the global economy and financial markets could arise from at any point in time. So again, the flight to safety to US government bonds shouldn't be underestimated. So as an economist, I end up in this unusual position where my strongest view is on currencies, actually.
We probably don't have time to address that, but one thing very quickly, can we just take a look at, you mentioned it here, fixed income. If we see a big move out of fixed income, there have been a lot of concerns about whether there's enough liquidity in the market to deal with that. How big a concern is that for you, Andreas?
It's a significant concern, but it's also an opportunity. I'll get to that in a moment. I think the concern stems from the fact that the market environment, the structure of the fixed income markets have changed. Long-term holders are very different from what they used to be. As we all know, the investment banks do not hold any more inventory. And so what we see is even in very minor market dislocations, we're seeing significant gap risks and therefore suddenly liquidity dries up completely. That obviously for long-term investors presents significant opportunities if you can switch out of cash into those undervalued, distressed assets then.
Okay. Do you have a very quick comment on liquidity, Diana?
Well, it's a really broad topic because we are entering a very different global situation where we'll have big parts of the world easing. In fact, we'd expect Japan to double up on its QE efforts and Euroland to have to move to much more substantial QE. At the same time, the US has just finished QE and is likely to tighten policy. So it creates a dichotomy that I think will be unlike what we've experienced so far. And I go back to my point that in this environment, equities will not be all buoyed by potential QE coming from Euroland and Japan, but it will be much more geographically split in terms of the US benefiting.
Thank you very much indeed for joining us. Very good to hear your comments.